The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Good afternoon. Welcome to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday at 3 o'clock. If you miss an episode, you can always catch me on Spotify or Apple, or go to my website, themainstreetcode.com, and you can find past episodes and keep up to date with all the latest trends. When we talk about our code, we talk about choice, organization, direction, and education. And we help hundreds of advisors across the United States and individuals with regards to life insurance, disability, long-term care, annuities, and life settlements. And we are completely independent. We represent 30 different insurance companies. We give completely independent advice. And companies look at things differently, and as far as underwriting goes, and as far as what your needs are. And we like to put you with the best solutions that are going to help you protect yourself and your loved ones in your life. Today I want to talk about my magic word, which is algorithms. Algorithms. You know, we talked about AI, but what is AI using? It's using this algorithm thing. And an algorithm is really an assumption based on a series of facts that AI is accelerating into doing things. So I had this big discussion with my doctor, believe it or not, on something that came up in my blood work. So when this particular thing came up in my blood work, he said, "Oh, you have X disease because that's what your blood work says." I said, "So tell me something about that test. What does that test really tell you? How can they make an assumption based on my blood work, and what factors go into making that assumption?" So I had to break it down because that's just who I am. I used to drive math teachers crazy. You can't tell me A plus B equals D without telling me how you got there. You got to draw the line. You got to give me the conclusions. Let me break it down for me, which he couldn't do, which I loved in one aspect. He says, "Well, based on this enzyme and this, but all those enzymes are normal. I don't understand why based on those enzymes, the assumption kicks out this." Well, basically, it's not a complete assumption. We have to do that, and that leads us to do other tests that will tell us that. And then the conclusion is when we do all these different tests, then we can conclude this is what you have. Ah, that's how an algorithm works. Thank you for explaining to me. Here's the problem. When you apply for life insurance or long-term care today, and you take a medication, or you take this, or you take that, all the insurance companies are using AI and these algorithms to make assumptions of what you're all about. We're seeing more and more companies today that are declining cases because of all these algorithms that they can now find out from using AI and getting all this information via computers about your health. That's scary. If you're to go online and buy insurance, that's all they do. That's why they can do no medical, no blood, because you're already on some algorithm somewhere. So we're seeing these online people that advertise on TV, on radio, on blast. Oh, you need life insurance. And they're only finding a 20 to 30% success rate in getting you the coverage you need because they're under the auspices of these algorithms. And they're actually putting you in an uninsurable state if you were to actually go somewhere else because you've already got a black mark against you on the medical board because they have given it to you. That's a problem. That's why you work with us, because when we know the prescriptions you're taking and everything else, and we can do a deep dive ahead of time, we can steer you in the right direction as to what company is going to accept you and maybe even give you the best rates out there by you not going through that process. But the automatic today is you go through that process. The stock market and hedge funds are based on algorithms. Scary. That's how a hedge fund works. And now with AI, so everybody's saying AI, what is this AI? What is this artificial intelligence doing? This artificial intelligence is gathering data and making assumptions, which is driving the stock market, and this is what driving hedge funds since hedge funds started. But now AI has sped up the process because you don't need as many human interaction to say what stock to buy, what stock to sell. Has nothing to do with anything else. It has to do with algorithms. And why do I say that? Because they're not always 100% accurate. When you add that extra element out there, that element of surprise, whether the government's going right or left or sideways or up or down, I'm not being political. I'm saying when we go to a war, when we go to this, all of a sudden the algorithms don't make sense because now we've thrown a monkey wrench into the whole mechanism. Now, I wanted to bring that up because what we do as an insurance wholesaler is we have to actually fight this AI machine that's getting people uninsurable when you're perfectly healthy. So that's why you use us. And there's another reason that I bring this up. The stock market right now is very scary, and I'm going to tell you why it's very scary right now and what you have to do about it. The thing I was listening to on TV today and what I've been reading about, and you're probably, if you're listening to the radio or reading the newspaper, we are now $40 trillion in debt as a federal government. 40 trillion. I can't even count that high. How did we get here? This is ridiculous. Okay? So what happens when we're in so much debt is we issue bonds, U.S. Treasury bonds. Now, what that does is as we issue more, the price goes down because you're flooding the market with something, and it drives interest rates up. It drives the yields up, which drives inflation and yield. And yield is the key thing. Yield is, okay, I'm going to offer 5% on a U.S. Treasury bond or 6%, whatever that magic number is, okay? 10-year rate is now 4.7%. I follow the yields more than I follow the market because the yields tell a big story. The yields are what drives mortgage rates. The yields are what drive interest rates on loans. So no matter what we do, when those yields are driven up, there's a bunch of things that are going to happen. One is maybe our children can't buy houses now. Okay, because the interest rates are so high. We can't artificially, the federal government, the monetary fund can affect short-term yields and try and curb inflation. But the long-term yields, the mortgages, the long-term yields are affected by our debt and the U.S. Treasury offering these things. Now, who owns all that debt? Scary, but foreign countries own that debt. So they have leverage against us because of the debt. Not necessarily the tariffs are going to solve everything. No, not at all. It's about controlling the debt. So that debt is growing tremendously, driving yields up. It's going to affect the stock market, and I'm going to say how, and I'm going to say how we can counteract that. You're listening to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. Best way to get a hold of me is 631-647-4694. Thank you. We'll be right back after a short break. Welcome back to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein, and we're coming right back, and we were talking about our debt of $40 trillion, driving up U.S. Treasury yields, which drive up the rates of mortgages and loans, which also can create a great deal of inflation. And prior to that, we talked about algorithms that are controlling buying decisions with the stock market. So we have a storm brewing. So I'm going to use my own algorithms, my own clues that I know from the beginning of time, the clues that tell me that there's a lot of turbulence ahead. So when you have algorithms buying stocks and you have yields going up, one of the things that tend to happen is a lot of the algorithms tell us, let's get out of the stock market and go get that heavy yield as massive investors and buy that yield of bonds. Let's go for the fixed money instead of the risky money. So that may give me pause to say, hey, I'm heavily invested in the stock market, yet the big money is moving out of the stock market to buy yield because they can. So that will drive the stock prices down and could happen in a very rapid rate. As we've seen over the last few years, movements happen in a second and they go up and down like yo-yos. Leads for a very scary thing about the market right now. The earnings per share and all that is so out of whack. Plus, with the yields being higher and higher, that's a scary thing because our loan rates go up if we're buying something or selling something. We have to be concerned about that interest rate. So what can we do as consumers, and why do we need to know this? Because we can see the signs, we can see the algorithms saying that the stock market is turbulent, the yields are getting higher, where can I park my money? And let's think about that. Well, one option is we can put it under our mattress. The problem with putting our money under our mattress or putting it in a safe somewhere is it doesn't keep up with inflation, which we're going to have more and more of, so it can't grow. Yes, I want to take the risk off the table, but part of the risk is inflation risk. So if my money is not growing and it's sitting in a bank making nothing, or a certificate of depreciation. People hate when I call CDs certificate of depreciation because that's what they really are, because you're taxed every year when you put that money in that CD. So whatever interest rate you make, you subtract the taxes, and is it really growing and keeping up with inflation? It can't, because government's taking a piece out of my earnings every year, so it can't work. So keeping it under my mattress, doesn't keep up with inflation, doesn't grow, Is it safe? Well, if it starts to disappear under my mattress, it's not that safe. If it's sitting in a certificate of depreciation, it's depreciating, not appreciating, because it's not keeping up with inflation. Yes, I could buy bonds and treasuries, or I could buy fixed annuities or fixed index annuities, where the money is guaranteed never to go down and keeps up with inflation, either in a growing interest rate or a fixed interest rate that is going to be higher right now than ever. It's higher because insurance companies issue annuities and they have to back it by what? A lot of their portfolio is backed by bonds, government bonds. So they have to keep that rate up. But the advantage over, let's say, a CD is you're not taxed on that money as it grows. So it's not depreciating. It's keeping up with inflation, and it's safe. So we want to handle safety, turbulent times, keep up with inflation, and not have it depreciate because they're paying taxes on it every year like a CD or even a checking or money market account. It's tax efficient. It grows. It helps keep up with inflation, and it's safe. So if you're worried about AI and you're worried about algorithms and you're worried about interest rates, that is one of the safe havens. Now, why do I always talk about safety? Because when you're 20 and 30 and 40, you're ready to jump off a bridge and you're not even thinking about the consequences. When you get 50 and 60, those consequences become more and more severe. You know, all of a sudden, you know, when I was in my 20s, I could do this, I could jump off of here, I can do that. I'm taking risk because I'm not thinking about maybe my family and kids and this and that. No, I'm on my own. Hey, I don't get hurt. I can play sports and I can do this and I can play basketball and I'm not worried about my back going out. But all of a sudden you hit your 30s and you have children and you start having health issues in your 40s, in your 50s. Now you're getting a little older and you have health issues and you're concerned and you're not jumping as quick and you're not jumping as high and you're not running as fast. Maybe you're not running anymore. Maybe you're walking. Maybe you're swimming. But you're not doing it like you were in your 20s. And so also you should be concerned with your investments, because now I really need them to last till my 80s, 90s, maybe till 100. And how are they going to last if all of a sudden the stock market fails like it did in 2008? I am not a stock market expert. I am not investment licensed anymore. I used to be. I gave up those licenses because I like to operate in the fixed world, quite candidly. I don't want that phone call, hey, my stock went down, and I never get that call because everything I have grows. Everything. It all grows. Everybody's happy. I specialize in fixed life insurance, fixed annuities. These things grow at a consistent rate. And are they going to make 20% a year? No. Are they going to go below zero? No. I like to operate in that safe zone. Because guess what? We need to be in a safe zone. And the older we are, the safer we need to be, because we can't afford to have that big catastrophe hit. We have to take money off the table if we're heavily invested and diversify it into more fixed elements, bond portfolios, life insurance, fixed annuities that are not only can keep up with inflation, but are tax efficient or tax free down the road, which is our big partner in everything we do. Yes, real estate's a great investment. Stocks are a great investment. There are lots of great investments, but they all come with consequences. Right now, my concern for myself and my clients is safety, protection, and growth. And there's only one way we can really do that with any kind of surety. You've been listening to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday at 3. If you'd like to get a hold of me, the best way to reach me is 631-647-4694. That's 631-647-4694. You can visit me on Spotify, YouTube, Apple, or the Main Street Code for Financial Success, or mainstreetcode.com. Thank you and have a wonderful day.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.